morning, and welcome to today's webcast, Tax Deferral Strategies and Credits for Property Owners. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our Group CPE Attendance Sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Today's presenters from Moss Adams, Jarrid, McAuliff, Matt Lord, and Aaron Coffeen. Jarrid has practiced public accounting since 2012. He provides tax planning and consulting services for corporations, pass-through entities, and professionals who own, invest in, and operate real estate assets. Matt is a licensed professional engineer in 48 states and holds a LEED accreditation professional in building design and construction. He has conducted thousands of Section 179D studies, helping commercial business owners and designers take advantage of this incentive. Aaron has practiced both public and private accounting since 2010. He has developed an in-depth knowledge and understanding of tax laws related to fixed assets, repairs and maintenance, depreciation, real and personal property transactions, and energy-efficient buildings tax incentives. With that, I will turn it over to Jarrid to get us started.
Hi, good morning, and thanks everyone for joining us today. Today we'll be covering 4 of the more common strategies and credits that could be applied to real estate investments, including developments and purchases of real estate. A lot of these have been around for 15 to 20 years, give or take, so it may be a refresher for you guys. But in addition to that, we'll be covering a lot of the new guidance and rules that have been coming out since about this time last year with respect to the new energy efficient incentives under 179D and 45L. Before we get too into the weeds with cost segregation, we'll kick it off with our first polling question of the day.
Awesome. Thanks, Jarrid. And I'll start us off with our first one. Is I'm most interested in learning about A, Section 179D, B, Section 45L, C, cost segregation, D, fixed assets, or E, I'm just here for the CPE. So I'll give you all about 30 to 40 seconds here to answer the polling question. To the CPE credit today, just remember you need to answer 3 of today's 4 polling questions. Make sure you select the answer and hit the submit button for your question to be registered. give everyone about 10 more seconds here before we advance on to the results slide. All right.
Yeah, so it looks like quite a few folks are interested in 179D. Maybe a refresher on cost seg as well. Again, we'll be covering the new rules on the energy efficiency stuff. Matt and Aaron will cover that in length. So we'll get moving on here. Through cost segregation, essentially this is a strategy that could be applied to the cost to purchase, develop, or renovate real estate assets. It's a play on the timing of tax depreciation by identifying costs associated with assets that could be depreciated over 5, 7, or 15 years, as opposed to building property that's generally recovered over 39 or 27 years. So what you end up with is all of this increased accelerated depreciation up into the early years of ownership, meaning you have less taxable income and tax liability to pay today. So the real selling point of this is the time value of money, having more money set aside today to put back into your operations or potentially other real estate projects. It ultimately provides the most value to individuals and businesses that have significant real estate asset holdings. We generally tell folks that means $2 million minimum associated with a building purchase or a ground-up new construction project. Alternatively, $500,000 associated with a leasehold improvement, building improvement, other type of renovation or remodel to an existing building. One consideration is who the ultimate owner or investors are in a given deal, just making sure that they can make use of all the accelerated depreciation losses. Many investors are considered passive, and there's loss limitations that come into play, meaning they could only take all this depreciation to the extent of income from other passive investment activities. If they can't use it right away, it can generally be carried forward for a period of 20 years, but it's just setting expectations with the investor group there so that they're aware of that. It also provides the most value to longer-term property holdings. When you take all this accelerated depreciation, it lowers tax basis in the property. So when you go to sell it, you have a larger taxable gain and potentially have to pay recapture taxes. But the way that property values have been going, we find that there's still some marginal benefit if you go to sell a property 2 or 3 years down the road, taking all the depreciation losses at ordinary rates and paying some of it back at more favorable long-term capital gains rates, but still ultimately provides the most value to those longer-term property holds. So we talked about some of the good candidates, $2 million or more associated with the new construction or property acquisition, and some of the building and leasehold improvements at $500,000 or more. One more important note here is that we could actually go back in time to real estate transactions that occurred in prior tax years and apply cost seg there with what's called an accounting method change filing with a current tax return. There's no need to amend prior returns at all. It's a pretty straightforward additional filing that essentially quantifies all the additional depreciation had you placed the cost seg assets in service in that earlier year. You're able to catch it all up right now. We can go back as far as it makes sense. Sometimes we go back 10, 15, 20 years there. So we wanted to briefly cover the process for conducting a quality cost seg study. We don't see these come up in exam too often nowadays, as it's not a hot button issue with the service like it used to be in the early 2000s. However, when it does, we find that the service does have engineers and former building contractors on staff that understand building components, valuation, methodologies, allocation issues, and so forth. So at a minimum, whoever you work with for cost seg, we recommend asking them if they're following, there's a audit techniques guide for conducting a quality cost seg study. Just asking them if they're following the minimum procedures and reporting criteria outlined in that. The process should really start with estimate of the anticipated accelerated depreciation tax deferral benefit should be reviewed with the owners and investors in the group, making sure that they can find utility in that. If it all pencils, minimum information should be gathered. That varies a little bit depending on if it's a brand new construction or an acquisition of a building. On-site property tour should occur to get eyes on the property, photo document assets and building components. Then using information from that site visit and other items gathered, we ultimately identify assets and assign tax basis to them with various methodologies there. The ultimate result should be a report that provides the legal tax basis for the classifications used and support for the methodologies used to assign costs to different assets there. So the cost segregation that we know today was really born out of the investment tax credit regulations from the 80s and 90s and case law that followed that into the early 2000s. And from all that, there's been a series of tests that help us distinguish between real and personal property. And what it really boils down to is certain building structure and system components that exclusively facilitate the use of business equipment within a building. Or maybe it's necessitated by the specific trade or business use of the facility. There's other tests that talk about lack of permanence and the ability to easily remove items, certain facade components, cabinetry, counters, things of that nature without causing damage to the building. And other items that really just serve an incidental relationship with the building. They may not necessarily be in every type of building, whether it's an office or a restaurant building. It's kind of unique to that property. We could take some of that as personal property. So what we end up with, in addition to the really evident movable 5 or 7 year machinery and equipment and furniture and furnishings, that's a little more easier to identify, we could end up taking items such as power outlets, electrical wiring, and portions of electrical panels that might power the end use, say welding equipment in an aerospace facility, or maybe plumbing and mechanical components that service end use kitchen equipment in a restaurant, or kitchen and laundry appliances in an apartment building. So it's pretty extensive digging into the building systems and other incidental items there, as you can see. It's not uncommon, depending on the building type, to get a 20 to 30% reclass from what would otherwise be building to 5 or 7 year personal property there. There's also guidance that outlines 15-year land improvements. Really, it's anything above and beyond initial site grading and shaping to make the land fit for its intended purpose. So especially as we look at industrials, multifamily properties, other types of developments that are more and more going to suburban and semi-rural areas as the pandemic's going to shape things. A lot of value in identifying these as part of the study. So I put in a couple examples here just to illustrate the difference in depreciation, how that's accelerated up. Let's say we have a $1.5 million renovation to an existing building. No cost segregation is applied. We could take up to $18,000 first year depreciation. Alternatively, we go through the exercise of cost segregation, break out some qualified improvement property, special 15-year leasehold categories, land improvements, personal property, end up with approximately $1 million of additional depreciation in year one, creating a good income tax deferral benefit there. Another example with a $2.5 million brand new building construction. Again, being able to identify those land improvements and personal property at more than about 30% of the basis there gives us about $500,000 of additional depreciation in the first year. This chart is more associated with the second example that we looked at here. So So we have almost $500,000 of accelerated depreciation. And then because we're lowering the tax basis of the real property that continues on for 39 years, we get straight line on the rest of that as compared to just depreciating the whole thing over straight line. So it provides great benefits up front there. So getting into fixed asset studies, I think we'll kick it off with another polling question again.
Great. Thanks, Jarrid. And we have our second polling question today. How comfortable are you with fixed assets and depreciation reporting? A, we have it covered. B, somewhat comfortable. C, overwhelmed. Too many rule changes and resources required to keep up with fixed assets. I'll give you all about 30 seconds here to answer this polling question. Reminder just to select the answer and hit the submit button to register your question submission. All right, I'll give about 5 to 10 more seconds here. All right, we're going to move on to the results slide.
Looks like most folks are somewhat comfortable with maintaining fixed assets and depreciation reporting. Some are feeling overwhelmed, and we understand depreciation rules have changed substantially over the last 5 to 7 years. I think as Obama was ending his term, he passed his signature tax plan that made a lot of changes to bonus depreciation, special leasehold lives, and then next administration came in and kind of redid everything, as we joke, especially for real property, how we depreciate buildings and leaseholds, bonus rates, all sorts of elections that change how we depreciate property there. So a lot goes into it. So a fixed asset study is really a comprehensive review of a company's fixed assets for the purpose of understanding how they're depreciating property. And the ultimate goal is to identify opportunities to create income tax deferral benefits, much like cost segregation, and also to address compliance issues. So it's most useful for companies with real capital-intensive structures requiring heavy investments in facilities, machinery, and equipment. We tell people that generally means $25 million or more in total fixed asset holdings. Companies that operate out of multiple physical locations, business units. We find that folks with decentralized accounting teams, if they have 5 different teams doing accounting for 5 different locations, sometimes there's 5 different ways of doing things. It's really industry neutral. It could apply to anyone, but we find that it provides the most value to manufacturers, healthcare organizations, aerospace companies, food and beverage. A lot of these types of companies require real heavy investment, especially in their facilities, to accommodate the business process for what they're producing or manufacturing. A healthcare organization might have to take apart a roof or a wall to install a new MRI machine. And I think one example from an aerospace facility, I think they built like a blast-proof, kind of bomb-proof walls to do non-destructive testing. And at face value, a lot of this type of stuff could appear to be a building type of property that needs to be depreciated over 39 years. But with a real good understanding of the industry and the business purpose and intent behind those expenditures, what we find is we can reclassify a lot of those types of capital projects to 7 or 5 year property and accelerate depreciation or repair expenses there on that type of stuff. So common issues that we generally see is less than allowable amounts of depreciation claimed, maybe using wrong recovery periods, methods, not using the correct rates of bonus depreciation, improvement property classifications. There's specific criteria to depreciate property over 15 years. Congress made this to incentivize investments to existing property. Generally has to be interior and non-structural in nature. So we either see one of two things: people being too aggressive with this and calling everything 15-year, or not exploring it enough and missing out on stuff. We see issues with projects never being placed into service. Maybe there's a perpetual CIP account, suspense account where people are booking projects to, and there's not a good handle on when those are actually being completed. Ghost assets or late disposals. Maybe somebody replaces 4 elevators or HVAC units in a building, but they forget to dispose of the older assets on the book. They're continuing to depreciate those over 39 years. About 10 years ago, there was a series of regulations that came out, commonly referred to as the tangible property regulations. It provided a lot of clarity to what types of capital expenditures could be expensed as repairs instead of capitalized and depreciated. So that's something we dig into with these studies as well. With the common denominator being bigger for analyzing expenditures to an entire building, what we find is a lot of things like painting a facility, replacing a roof, things of that nature could actually be expensed as repairs. The process at a glance, we usually start with reviewing tax depreciation records just to understand how property is being recovered, especially in the building improvements, leasehold improvements, those types of real property capital expenditure accounts. And provided that there's opportunity there to accelerate losses or maybe clean up some compliance issues or both, we proceed with a mix of client personnel interviews and reviewing any available ledger data, invoices, and so forth, really understanding the business purpose and intent of each of the capital projects to see what we could do in terms of changing lives and methods of things, usually from 39 years down to 5 or 7 years, or best case, a tax-deductible expense, creating pretty big deferral benefits for both federal and state filings there. I would say the best part of the process is the client usually comes out of the exercise with a better understanding of capital projects and how to treat items, and we usually proceed to working on capitalization policies to get a better handle on those, so they're not missing out on depreciation or repair losses up front. So as an example, we have a sawmill that has locations across the country. A typical sawmill will feature kilns for drying lumber, main sawmill building, and finished goods storage sheds to store and dry lumber. And over a 12-year period, they capitalized $15 million of improvements to their sawmill buildings, all as 39-year property. In 2023, they decided to take a little bit closer look and do a detailed review there, and they find that $12 million of those improvements actually facilitated the installation of sawmill equipment that's integral to its business processes, should have ultimately been classified as 7-year property that they could take bonus depreciation on, or at a minimum just faster than 39 years. So this is actually a real example. Ended up being the construction of a lot of freestanding sheds with specialty HVAC improvements to dry green lumber, as well as special fire systems to protect all the dry wood there, electrical, plumbing type of projects to facilitate very specific equipment going in. Very automated type of sawmill property, and required a lot of capital projects, both to just upkeep and maintain it and to add new equipment over the years. So as you can see, maybe year over year for a 12-year period, the $15 million might not be much, but over time it really adds up and compounds, and we could end up catching up quite a bit for folks there. So we have another operator of apartment complexes. They invested in a lot of their properties in the early to mid 90s. And then again, over a 12-year period, they spent $10 million replacing existing roof coverings, siding, windows, rebuilding exterior decks, maybe doing some parking lot work, the asphalt. With these properties being 15 to 20 years old, they just require extra TLC to keep them going there, extra money in. They decide on their current tax return to do a deeper dive in there and ultimately end up finding that $6 million relates to tax deductible repair expenses. So this case was actually a California filer. So in addition to all the accelerated repair losses for federal, although California doesn't allow accelerated depreciation, but they do allow repair expenses. So they got all that California income tax deferral benefit there as well. And the important thing that I might have missed before is that you can catch up on all these depreciation and repair losses with a method change, just like we could do for cost seg to catch up on your current tax return. No need to go back and amend prior returns there. Now I'll hand it over to Matt to talk about energy efficient building deductions.
Yeah, thanks, Jarrid, and good morning, everyone. We're going to start talking about Section 179D, which is the energy efficient commercial building deduction, and a little bit of history. So Section 179D has been around since 2006, and it went through multiple cycles of several year extensions and lapses and extensions. And then finally, at the end of 2020, it was made a permanent part of the tax code. And historically, it's been valued at up to $1.80 per square foot with multiple inflation adjustments for the past 2 tax years. And it was created to incentivize energy efficient commercial buildings, specifically around 3 systems: the HVAC and hot water, interior lighting, and building envelope systems for both new construction and renovation projects. And until the Inflation Reduction Act, 3 groups have been able to claim Section 179D. Those include owners and tenants of commercial buildings, owners of 4-story or greater residential buildings, as well as designers of government-owned energy efficient buildings. And so for the purpose of this discussion, we're going to focus on those first 2 groups, which are outlined in green, and we'll also cover the major areas of modification to 179D as it relates to the Inflation Reduction Act. And so those new rules as part of the IRA will take effect for properties placed in service starting after January 1st, 2023. So on the following slides, we're going to be presenting the pre and post IRA considerations to kind of illustrate the impacts of those changes. And so right off the bat, the first substantial change that was made to 179D relates to who is eligible to take the deduction. From the building owner perspective, the same initial groups can continue to claim the deduction as they were able to before, with the addition now of real estate investment trusts, or REITs. And then on the designer side, there was a significant expansion of buildings that can be allocated to those designers by opening up that process to include tax-exempt entities, along with those initial public entities. All right, so the largest modification of 179D relates to the amount of the deduction and how those different amounts can be achieved. And so as you can see on the left side of the screen, the maximum deduction has been equal to $1.80 per square foot when you achieve energy savings of 50% or greater. And in the event you don't hit that 50% threshold, there are partial deductions available of 60 cents per square foot for each one of those 3 eligible systems. And those partial deduction rates had lower energy qualification thresholds. For instance, HVAC required a 15% energy savings in order to achieve that partial deduction. Those full deduction amounts, along with the partial deduction amounts, were also marginally inflation adjusted for the past 2 tax years in 2021 and 2022, up to a maximum of $1.88 per square foot. But now under the Inflation Reduction Act rules, there is no longer partial deductions. Instead, we're looking at a sliding scale with a minimum energy efficiency threshold of 25%. And if we're looking first at the base deduction case on that top right section of the screen, if you achieve the 25% energy savings, you qualify for a deduction of 50 cents per square foot. For every percentage point that you go above 25, you gain an additional 2 cents per square foot of deduction, up to a maximum of $1 per square foot if you hit that 50% or greater energy savings. Now, if you look in the case of the bonus deduction, those values are all multiplied by a factor of 5. And so we're going to discuss how to qualify for those bonus deduction ranges in a few slides. But obviously that new bonus deduction range represents a huge increase from the historic 179D amounts, even at the low end of the energy savings range of 25%. And this new sliding scale will be really beneficial for projects not reaching 50% energy savings, which that is a high target. And that tends to be the case, at least more the case, for renovation projects, depending on the scope of the renovation. So under those old rules, let's just say if a building achieved a 37% energy savings, you would likely only be able to qualify for a partial deduction of 60 cents per square foot, which makes it a little bit of an all or nothing kind of proposition on achieving that higher deduction rate. But now with the IRA rules and that sliding scale, if you take that same 37% energy savings, that could yield a $3.70 per square foot deduction if we're in that bonus deduction range, which is obviously a much higher deduction available compared to the same case in the pre-IRA law. Now, the IRA also changed something that is referred to as the deduction cap. And so effectively, since 179D was created in 2006, there's been a lifetime cap of available 179D deductions, which has been equal to $1.80 or $1.88 per square foot. And once this has been claimed, even if you make additional energy upgrades at your facility, you cannot take 179D again. Now, there is a 3-year cap for the building that allows you to take those further deductions as long as the previous full deduction claim occurred more than 3 taxable years ago. And this really helps incentivize new energy efficient upgrades at your facilities. And it was a welcome change because since this incentive is almost 20 years old, let's just say you claimed this in 2006, we're about 20 years away from when you made those first upgrades. And so you're likely due for more renovations if you haven't already done them. And so just to not have this available to you really goes against the spirit and intent of the program. So this is a really nice thing to have to allow you to continue to take 179D as you prioritize investment into your facility. All right, so now we're going to discuss how to qualify for that significantly higher deduction rate of up to $5 per square foot. And on this slide and on this presentation, we've referred to that as the bonus deduction range. And that is available when local prevailing wage and apprenticeship labor hour requirements are met. I'll just say for this webcast, we're not going to really dive into the details of those prevailing wage and apprenticeship requirements, since they are quite extensive, but there is a webcast coming up on November 30th where those regulations are going to be covered in more detail. So I encourage you to sign up for that one and attend, as it'll be really good content for people who are interested in achieving those prevailing wage labor requirements as associated with the higher deduction and credit amounts. But with that being said, at a high level, all the laborers on a construction project must be paid prevailing wages as determined by the Department of Labor, which is based on the type of work and the project location. And then on the apprenticeship side, there is a percentage of overall labor hours worked that have to be worked by registered apprentices. And that percentage you need to hit is based on the start of construction date. It ranges from 10% up to 15%, depending on where that construction start date occurred. And along with those prevailing wage and apprenticeship requirements, which I want to emphasize, that is a both prevailing wage and apprenticeship. It's not one or the other, unfortunately. There is a tracking and reporting requirements that are in place as part of the IRA. And so those are meant to substantiate those labor rules that have been achieved. And that will be covered in more detail as part of that webcast on November 30th. Now, one important thing to note here at the bottom of the screen, you will see that you are not going to be held to these new requirements so long as the construction of your project began prior to January 30th, 2023. So projects that started before this date are automatically eligible for the higher deduction rate of up to that $5. And the start of construction date is determined via two different tests. One is the physical work test, and the other one is the 5% safe harbor test. But in practice, what this is going to mean is that many projects placed in service in 2023 and into 2024 will be exempt from meeting those prevailing wage and apprenticeship requirements, which will be a substantial boost to the 179D deduction available on those projects. Now, this slide is just meant to show some examples demonstrating the magnitude of the available deduction before and after the Inflation Reduction Act. And those post-IRA deduction maximum values are based on meeting those prevailing wage and apprenticeship requirements or being exempt based on that construction start date. And then if you don't meet the labor requirements or are not exempt, then the maximum value would drop by a factor of 5. And then at the bottom of the screen, it's important to note too, the overall 179D deduction claimed cannot exceed the total capitalized cost of the energy efficient equipment. So let's just say in that first case of the office, you got a 50,000 square foot facility. Let's say you're in the exempt period, so you're eligible for up to $250,000 deduction. Let's say you put in new lights of $100,000. Even if you're eligible for up to $250,000, you are capped at that amount of the cost of property. So that would be a $100,000 maximum deduction in that case. Now, there are a handful of other 179D updates that I want to just briefly mention, and they'll be especially noteworthy to those of you who have pursued 179D in the past. Prior to the IRA, parking garages were eligible to be claimed for 179D around a partial lighting deduction. But that is no longer the case based on the current guidance we have from the IRS. And that's because, as we mentioned a few slides ago, there is no longer a partial deduction option. And all energy efficiency assessments have to be done via building energy models or the new pathway that's called the energy usage intensity or EUI path. And so we're still awaiting guidance around this path, along with many of the specific considerations around 179D. But this new pathway called EUI will allow for actual energy reduction of renovation projects to be considered as part of how to quantify 179D separately from the energy modeling, which has been the historic way of doing it. All right, so now that we've covered 179D and kind of the recent modifications to it, I wanted to discuss the process of how you claim it on your tax return. And so before conducting a full-fledged study, we're going to perform an initial assessment to ensure that the project represents a good candidate. For 179D, that includes verifying things like project scope, place in service date, that the interested building owner paid for the energy efficient improvements, looking at the drawings. Once we've got that all squared away, a third-party firm like Moss Adams will construct an energy model based on several different industry standards and then perform a site visit of the facility by a licensed professional engineer in the state where the building is located, which is someone like me. And so that site visit will consist of verification of different energy efficient features of the building to ensure that the drawings and the documentation and energy modeling are all consistent with the building and accurately reflect its as-built condition. A certification and report are then issued, and then you claim the deduction under the other deductions category while also filing a new Form 7205. And this was a new requirement introduced for tax year 2022. Now, if you're looking at going back to prior tax years performing 179D studies, as a commercial building owner, you're able to go back as far as 2006 to claim the deduction. And you have to do that via a Form 3115, which is an accounting method change form similar to what Jarrid discussed on the cost segregation side. And since 179D is an accelerated depreciation benefit similar to cost seg, there is a basis reduction of the property for the amount claimed of the 179D deduction. So that's either on the respective 39-year or 27-year depreciable property. And for that reason, the benefit of conducting a 179D study is typically greater on a current tax year or recently completed project, but you do have the opportunity to go back as far as 2006 should that be something you're interested in pursuing. And with that, Chad, I think we have another polling question for the audience.
Thanks, Matt. Yeah, and we have our third polling question for the day. Under the IRA, what is the maximum amount of 179D deduction per square foot? A, $1.80, B, $5, C, $1, or D, $2.50. I'll give you some time here to answer this question. Another reminder, please select your answer and hit the submit button to receive credit for this polling question. All right, we're hitting about the 80% mark here. I'll give you about 5 to 10 more seconds. All righty, gonna move it on to the results here. What do we got?
All right, so we got a little bit of a spread here. So a couple of trick questions in here as far as the answer choices, just to see who's most paying attention on the different rules. But the answer is actually $5 a square foot is the maximum amount. That's assuming, of course, that the bonus deduction, prevailing wage labor requirements are met, and the $1.80 that was the most popular answer choice, that would be under the old rules. So under the new rules, we're up to $5. Old rules are $1.80. So with that, I'm going to kick it over to Aaron to talk through 45L.
Excellent. Thank you, Matt and Jarrid. My name is Aaron Coffeen, and I work with the 45L New Energy Efficient Home Tax Credit. There are a lot of similarities between the 45L credit and the 179D tax deduction. One important difference is that 45L is a tax credit, whereas the other incentives we've been discussing today are tax deductions. So we'll go over high level what the changes were for the Inflation Reduction Act. The 45L tax credit has been around since 2006. It was one of those credits, like some others, that would sunset every year or after a couple years, and then different administrations would have to reenact or retroactively reenact the credit for the next year or two going forward. So there wasn't a lot of certainty behind the credit until the Inflation Reduction Act. That was one of the biggest changes. So now we have some certainty, and the 45L credit is through the year 2032. So we have about 10 years to take advantage of this credit now. So it's basically a new credit. The IRA overhauled it pretty substantially from its existing state. So all that went into effect at the beginning of the year, starting January 1st, 2023 this year. The base credit amounts changed. They added the prevailing wage option, like Matt talked about, for an increased bonus credit amount for multifamily developments. They removed a story height requirement. Prior to this year, the 45L credit was only available for properties that were 3 stories or less. And then they also changed the energy efficiency testing requirements. And there is a required reduction in basis or the cost of goods sold if you're selling a property. They made that exempt, though, for properties that are also claiming the low-income housing tax credit. So 45L unlike 179D, it only applies to residential properties. So those properties that are listed down below there, so single family homes, modular homes, townhomes, multifamily developments, and then manufactured homes also. So it's not available for commercial buildings, and it's also not a transferable tax credit. And so who can, a good candidate, so the code reads 45L tax credit is available for an eligible contractor. That term eligible contractor is not like a general contractor or, the person, a subcontractor, building the property. What the IRS defines eligible contractor is trusts, estates, partnerships, corporations, individuals who have basis. So people, companies that have basis in the construction of these residential units. So the eligible contractor must also then sell or lease the property to essentially trigger the tax credit. And then it also needs to be Energy Star certified currently, or previously it was under a prior energy testing requirement. But you can go back, it's important to note, you can go back to prior years to claim the 45L tax credit. It's available, if you wanted to claim it for prior years, it's available to amend returns. So any amended return, you can amend open year returns to claim that credit in prior years. But so we're just going to focus on the changes, what it looks like now. So starting 2023, going through 2032, what does the 45L credit look like? So you can see prior, it was a $2,000 tax credit. Didn't matter what type of property, single family, multifamily, maximum for manufactured, still $2,000 per credit. So starting this year, it changes. It depends on the type of property. So single family homes, great news. The credit amount went up to $2,500 per unit if you achieve the Energy Star certification, and $5,000 per unit if you achieve Energy Star plus what's called the Zero Energy Ready Home certification. And there is no bonus credit for single family homes related to the prevailing wage requirements. So for multifamily, bad news is the base credit went from $2,000 down to $500 per unit, but then it added on some additional tiers. So if you satisfy the Energy Star plus Zero Energy Ready Home for multifamily requirements, you get $1,000. Then you add on prevailing wage and Energy Star, you get $2,500 per unit. And then finally, the maximum credit amount of $5,000 per unit if you can satisfy the Energy Star, Zero Energy Ready, and prevailing wage requirements. So it could be up to $5,000 per unit. We're seeing a lot of the properties come in at the $500 per unit range, but there are quite a few that have met the Zero Energy Ready requirements because a lot of properties are currently being built to higher energy efficiency standards as is. So also the manufactured home requirements kind of follow the single family home requirements. Manufactured homes are defined as homes that are built in a factory. So modular or site-built homes would probably fall under the single-family home requirement there. Townhomes also fall under the single-family home definition. So anything that is a single unit floor to ceiling is going to fall in that single-family home. You start getting into stacked units. That's where the multifamily properties come in to play, and we'll look at that here in a second. So as I mentioned, the Energy Star requirements, they broke out the single family and multifamily property definitions. Previously didn't matter. It was all the same credit. So now you have to define, what is it, a single family or multifamily? Energy Star has a lot of information out on their website. It's a Department of Energy program. Most people are familiar with it from appliances, but they actually have a program to certify not only single family and multifamily, but other commercial buildings. So there's a lot of information out there. So again, getting into the Energy Star a little bit more detail, the single family home national program requirements. Right now there's version 3.1 and 3.2 out there. The townhome, as I mentioned, is basically a floor to ceiling unit, and the multifamily, it gets into the stacked units. So manufactured, again, built in a factory. And then the multifamily new construction program. There's a couple different paths to satisfy the national program requirements, and mixed use properties must have over 50% of square foot as dwellings and common space. And this is the biggest change to the credit. So prior, you could do before this year, to claim the 45L tax credit, you could do an energy model on a unit after it was already completed and leased or sold. Going forward, Energy Star is a little bit more involved. It requires planning for and having on-site inspections and testing done throughout the construction process. So early on, you want to plan for it. Although we've found that depending on where you're building, if you're building to more recent building codes, 2018 or newer, just by building to those codes, a lot of properties are meeting the base Energy Star requirements just on those stricter building codes. So we see a lot of properties in the Pacific Northwest, California, Colorado, that are constructing new projects, and they're not having to add on any special, solar panels or heat pump or geothermals or anything like that to be able to qualify for the credit. So a lot of it's based on, what's the R values, what's the U values, what are the what's the HVAC units, what's the water heater look like. A lot of those things go into determining the energy consumption for the Energy Star requirements. So it's important to get started early, start planning for meeting the Energy Star certification. Like I said, if you're in a certain area building the recent building codes, it's probably not going to be hard to meet those specifications. The Zero Energy Ready is above and beyond Energy Star. So the property must meet Energy Star, and then also Zero Energy Ready includes some more duct sealing, some more envelope sealing. It requires stub outs to be solar ready, and some other energy efficient features like that to meet that Zero Energy Ready. But we are seeing some properties that are being built to those standards. So we have 9 more years under the new credit requirements to plan for and take advantage of this. And the Energy Star program is going to be a more collaborative approach. Like I mentioned, the builders need to be registered with Energy Star. It's a pretty simple process. You go on their website and I think watch a 5 or 10 minute video and you're registered. There's requirements for the testers. After the units are completed, there's some HVAC testing that can need to be done on the HVAC ducting or blower tests that need to be completed. And then, yes, so it can also be used in combination with 179D. Like Matt mentioned, 179D is available for multifamily properties that are 4 stories or greater. And you can include cost segregation or repair and maintenance expensing on renovation projects. So you can really package all these together if the project checks out. IRS notice, so the 45L tax credit, this is a new one, essentially with the IRA. And so they are still updating and releasing or clarifying certain portions of the credit. And so they just recently released a notice that helped clarify a lot of the kind of uncertainties that people had questions about the new requirements starting this year going forward. So that was super helpful. And then there are proposed rules for the prevailing wage and apprenticeship requirements that were released not even 60 days ago, and those are not final. Currently, the 45L credit does not have that beginning of construction requirement or exception to meet the prevailing wage like 179D does. And so that's a key note to take away. The prevailing wage requirements for 45L right now must be satisfied from the beginning of the year. And a couple other takeaways. So the credit is available for newly constructed or substantially renovated residential units. So those multifamily, single family homes. So those units, if you're an eligible contractor, if you're building those, you're paying a contractor to build those for you, you're the developer, the home builder, you could be eligible for that credit when that unit is leased for the first time after construction, or sold if it's a single family home or townhome. So the first time that unit is sold, leased, transferred after construction is when the credit becomes available to you, as long as that unit has also been certified to meet the energy reduction requirements. So once you've done all that, you can claim the credit on your tax return. And then there's a required reduction in basis if you're holding that property and renting it, or a required reduction in your inventory cost or cost of goods sold for that unit if you're selling it. So that's kind of the process, to go through, a multifamily example. So say you built a 100-unit multifamily property and you met the base Energy Star requirement and you leased up all the units in 2023. That would get you a $50,000 tax credit. If that same property were to meet the Zero Energy Ready certification, you would get a $100,000 tax credit. If you were to meet the Energy Star and prevailing wage requirements, that credit becomes $250,000. And then if that Zero Energy Ready plus prevailing wage, you could get up to $500,000 tax credit for that 100-unit multifamily property. So potentially, it's a very, very good credit. And we can handle everything from the energy certification to looking to see, if you can utilize the tax credit on the front end. Let us know. We're here to help through every stage of the 45L credit. It sounds like a lot, but it's actually pretty simple to get, and we're here to help. So our last polling question, a couple minutes left. You want to kick that off?
Yeah, thank you, Aaron. And we have our fourth polling question and final polling question of the day. Can an eligible contractor combine the 45L tax credit with the 179D energy efficient building tax deduction and cost segregation tax incentives? A, yes, these are available for all properties. B, no, you can't combine credits with deductions. C, yes, but only if the property is a multifamily, 4 stories or more, and newly constructed or renovated between 2023 and 2032. I'll give you about 20 to 30 seconds here, kind of submit your answers, and
yeah, we'll see who is paying attention to some of those finer details we went over there.
And while folks are responding to that polling question, we know some questions came into the Q&A out there. We've made note of those so we could follow up with you over email. Apologize. An hour is kind of tight to get all the content in here.
Great. We'll give it about 5-10 more seconds here. Get on to the results. All right.
All right. Wow. A lot of people are paying attention, which is encouraging because I think the first slide said only about 5% of the people here were here for the 45L part. So I'm glad everyone kept paying attention throughout. We thank everyone so much for your time, and we will be following up with questions that came in the chat and anything else we need to cover. And here's our contact information. If you'd like to reach out directly, we'd be glad to talk to anybody.
Awesome.
Thank you.
Thank you, Jarrid, Matt, and Aaron, for a great presentation today. Like Jarrid said, if we didn't have time to answer your questions, we'll do our best to follow up with you post webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certification is available to download now in the CPE progress window. I'll keep the webcast open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here's a link to our online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.